Have you ever received the "You're pre-approved" letter for a new credit card? Or perhaps you had that ad pop up on your screen to "Just click here and get approved today." Did you apply? Chances are, if you did apply, the financial institution offering you that amazing deal used data analytics to determine if they should issue you a credit card. Are you a risk to the institution? If so, how much of a risk? Either way, it will determine if you should get a card, and if so, how much of a limit you are eligible for. According to Davenport and Meidel, the financial sector is a data-rich industry that has leveraged data analytics for years and has been an active adopter of artificial intelligence to help with its client-facing services. Today's presentation will explore the financial industry use of data analytics and machine learning specifically for assessing the credit risks of its clients. One of the earliest uses of AI-based solutions for the financial industry is credit risk analytics. This application of technology goes back to the 1980s with the application of neural networks and the development of the FICO score. FICO stands for Fair, Isaac and Company, which is the organization that developed it. The use of the FICO score changed the financial sector by helping quantify a client's credit risk to a single number. The score is based on the customer's previous financial experience, which includes things such as length of credit history, amount of money owed, new credit recently extended, and payment history. Using the descriptive data, financial institutions had a better way to determine which of the customers were likely to pay back loans with interest and those at risk not to. The industry quickly learned that a customer's FICO score correlated to the likely predictive behavior of the individuals in general. Those with higher scores tended to repay loans on time. Today, it is a standard to have a credit score chart, such as the one displayed here on the screen, with ranges of FICO scores to determine eligibility for credit and, if you do receive credit, at what interest rate you should be charged. There's a problem with the FICO score, though. It is only a snapshot in time based on past credit behavior. The FICO score provided generalities for people that fell within a range, but people and their behaviors are dynamic. This static data point does not necessarily reflect the dynamic journey of the individual who may actively be trying to improve their credit rating. In today's market, where the use of analytics and AI-based solutions are applied to give a competitive edge, some companies have been able to use machine learning to identify customers that may appear to be at high risk for loans on paper, given their FICO scores, but additional data points suggest they are in fact a lower risk than indicated. This opens up a whole new market for financial institutions and improves the patient experience overall. Synaptic Systems, Inc. is a company that has produced a third-party platform that can help provide a fair lending experience for financial institutions. It has partnered with several credit unions across the country. Synaptic offers a deep credit experience. This machine learning algorithm pulls data from the national credit bureaus, getting a trend for the FICO score of the applicant. Then it compares that information to the credit union's internal data and underwriting practices. The outcome is a dynamic credit score based on multiple data points instead of just one static number. For example, a FICO score moving from around the low 600s to 700 is looked at more favorably than a FICO score that is moving from the 700s down to the 600s. The former demonstrates an improved pattern of behavior, and as an added bonus, the decision made by the AI model are almost instantaneous according to the company. Not all machine learning algorithms are perfect, though. If a model is not built correctly, or if it is not fed the proper information, bias could creep into the system. For instance, a study out of Stanford University identified that some low-income or minority applicants for home mortgages were turned down at a higher rate than their counterparts using machine learning-based approval models. The researchers found that the problem with the models is that the minority and low-income applicants often had less credit data to draw from for its predictive analytics. Credit history itself is a factor in determining credit scores, so the lack of credit history is a negative factor in determining approval status. If perpetuated, this cycle could create a negative feedback loop in which disadvantaged populations cannot get approval for loans and build credit because they lack the credit history. This problem, though, is not insurmountable. Data scientists working with machine learning can take a page out of Salesforce's book in creating ethical models that would take into consideration these disadvantaged populations and tweak the program to either consider approval or potentially flag it to be reviewed by a human reviewer for final decision. Despite the potential gaps for disadvantaged populations, I think that the use of machine learning algorithms for credit risk assessment is a win-win for customers and financial institutions. Programs like the ones used by Synaptics can open up new opportunities for credit seekers that may not have been able to be approved before, and financial institutions can find new customers in a niche market that, although appear high risk on paper and to traditional methods, are really low risk and eligible for credit and loans. This is just one of the many ways that the financial institutions are using artificial intelligence to improve your experience in getting new lines of credit. Thank you.